Okay, so just to make sure we know what we're doing, what the point of this chapter is I think, or at least this part of it, is this diagram. So I'm just going to talk about it one more time so we all are very clear about what happens when receivables go bad. We know that we're not going to be able to collect all of the accounts receivable that we generate. We know that the real world is messy, and some people that we extended credit to are not going to pay us back. So what do we do about that? Well, we have to reduce our net income by that amount, because when the account receivable is created, we're increasing our net income, because we have account receivable, sales revenue. This is the journal entry. So this sales revenue is increasing our net income, but we know that some of the AR is not going to actually materialize. So that when we create this account receivable, we'd be overstating our profitability if we didn't account for the account receivable, some of it not getting paid. So in order to do that, we are going to take some kind of expense, okay? Because that's going to offset this revenue that's being recorded, and it's going to offset it by this amount that we expect to not be able to collect. Or in the case of the direct write-off method, how much we actually don't collect. Okay, so we're going to offset the revenue that we recorded when the account receivable was created with an expense. So again, there's two ways that we've talked about doing that. The direct write-off method is when you realize that the whatever account receivable is uncollectible. At that time, you're going to take the expense. So the problem with it is that you're not going to match up this revenue in the same period as you're going to take the bad debt expense, because the bad debt expense is going to happen in some future time after you've given your customer some amount of time to pay off the account receivable, and they don't pay you. And at that time, you're going to then take the bad debt expense. Okay, so we're going to violate this matching principle if we use this direct write-off method. The other method is the allowance method, where we estimate. We don't know ahead of time who's not going to pay us, but we estimate based on some analysis, based on historical records, what portion or how much bad debt expense we can expect to take in the future. And based on that expectation, we set up this piggy bank that we can then write off those uncollectible accounts in the future. Okay, but at the time that we do this adjusting entry using the allowance method, we're going to take the expense in the same period as this revenue, so that they're going to be matched together. Okay, so we're not going to overstate our net income. Well, we could overstate it, because again, this is going to be based on an estimate. We don't actually know how many of our account receivable are going to not be collected, but at least it's trying to be a little more accurate and matching up the expected uncollectible amount with the revenue. Okay, so again, how do we get uh, the estimate for bad debt expense if we're using the allowance method? We have these three ways of doing it. The first one we talked about already on Monday. The percentage of sales method, we just see how much sales we generated, either the total amount of credit sales or the total amount of sales, and we apply some percentage to that. Okay, and so it's not looking at what the account receivable balance is. It's just looking at the sales that happen, and we're gonna use that to kind of uh, make an adjusting entry to our allowance for bad debt. This is like our piggy bank. We take the expense for bad debt in the period, and then we put basically some amount into this piggy bank of allowance for bad debt. This is a contra account. It's a contra asset account because it's paired up with account receivable. Okay, so this piggy bank now has some uh, kind of allocation to it that we can now write off accounts receivable. And we saw that as we actually write off accounts receivable, the net amount of accounts receivable is unchanged. If you remember, we did this where we have our total amounts, our accounts receivable, and we have this piggy bank. The net is 14,000. This is how much we would show on our balance sheet because it's kind of this debit less this credit balance. So this already accounts for $1,000 worth of accounts receivable not being collected. We've already kind of pre-allocated for that. Okay, so when we actually go ahead and write it off, we saw here, right? We wrote off this guy, Wilson. We realized it's not going to pay us. And we then dipped into this piggy bank of $500. So we saw here that this allowance for bad debt gets reduced. Our piggy bank is smaller now. Our accounts receivable is smaller because we've actually written off some of it, but the net amount is still unchanged. Okay, so that's an important concept to keep in mind that these two together kind of give a net amount that's already presupposed some amount that we're expecting not to collect. Okay, I think we then did get into this other method, percent of receivables, which is a balance sheet approach, which is not really looking at how much credit sales or sales we generated. It's just looking at what is the ending balance of account receivable and then applying a percentage to that to say what percentage of that do we expect not to collect. And that's how much we're going to set the target of our piggy bank to be. Okay, so that was a different approach. Remember, with the percentage of sales method, we just had our percentage and then we saw how much sales we had and that we applied this percentage and this is the amount of the adjusting entry. It didn't really take into account how much we have in our allowance for bad debt piggy bank already. It just calculates the expense just straight up. Okay. Now we're with the percentage of receivables method. We're saying how much should be in our piggy bank total by the end of the adjusting entry. We then factor in what our existing balance is in our allowance for bad debt, and then we figure out what our adjusting entry should be based on that. Okay, so it's kind of starting at the end point. We're starting with the target balance, and then we're backing into what the bad debt expense should be. Okay, so I think unless anyone has any questions, anything we need to clarify here, we're just going to kind of do a practice problem where you can use this method. So does anyone have anything they want to ask or clarify before we do that? No? Okay. All right. So let's work on that practice problem. Okay, so let's just make sure that everyone is on the same page of before the adjustment happens, what the balances are. Okay, so for account receivable, we have a balance of 34,000. It's going to be a debit balance. This is not explicitly stated, but we know assets are debit normal. So this is our beginning balance. And then the allowance for bad debt has a credit balance of 3,000. So these are our beginning balances. Now let's do our journal entries. So we have sales of 189,000. So we're gonna have sales revenue. Okay, and that's split between 165,000 in on credit for accounts receivable and 24,000 for cash. So we'll have cash, accounts receivable. We're not really doing the cash T account. We're just really, this exercise is for receivables, so we won't worry about that. But we do have this debit of 165,000 from the period. Okay, so this first one is done. Collections on account, 133,000. So what that means is that of this total, right now we have 199,000. 133,000 of that got collected. Those customers paid us. So we're receiving cash and we're reducing accounts receivable. Okay, so I put this. And so now my balance, this is my unadjusted balance. Because remember, we're going to do an adjusting entry for allowance for bad debt. But right now, our unadjusted balance at the end of the month is 66,000. Okay. Okay, so then we did this one. So the last one, C, write-offs of uncollectible receivables. Actually, sorry, I'm wrong. We still have to do this. This is not complete. So write-off of uncollectible receivables 2,800. So what that means is that we've determined that some of our account receivables are uncollectible. So we're going to write those off. We're going to reduce account receivable by 2,800. But we're also going to draw on this piggy bank. We have this $3,000 set up to kind of account for that. We expected this to happen essentially. So we already have that uh, allowance for bad debt piggy bank that we're going to debit. Okay, so now we'll have our unadjusted balances. And then this is going to be a credit balance, 200. Okay. So everyone good here? Everyone got to this point? No? Okay. So I will pause it here. Now, what we are saying is that this allowance for bad debt, the unadjusted, we need we need to change this because now we have in number 3, we want to have this allowance for bad debt be a new balance based on our ending balance of account receivable, which we also have here. Okay, so we're going to use this 63,200 with the information in number 3 to figure out what this should be. Okay, so that's going to be X. So once we have X, we can figure out what our adjustment has to be. We had on the quiz, we had this where we know what the balance is going to be in the T account, but we need to then figure out what needs to be debited or credited to get to that. So you're going to kind of use what you did on the quiz to finish this. Okay, so take a couple of minutes, see if you can just finish that up. Okay, so what this is saying is that uh, we're assuming that the bad debts are going to be 2% of the accounts receivable. That means that whatever balance we have at the end of January, we're expecting that we're going to collect only 98% of it, and 2% of it is going to be written off. Okay, so what is the balance? 63,200, and what is 2% of that? Let's see. This times 0.02, 1,264. Okay, so that's going to be our target balance here. Okay, so this should be our ending balance. This should be our adjusted balance. And we have an existing, and we know allowance for bad debt is a contra asset account. It's got to be a credit balance. We have an existing credit balance of 200. So to get our adjustment, we just take our target balance minus our existing credit balance, and we get 1,064. So that's how much more we need to add to allowance for bad debt to get to this target. Okay, so we would just do 1,064, 1,064. We're going to take this. The whole point of it is to record an expense called bad debt expense. And we're going to add that kind of like a loss you can take to this piggy bank called allowance for bad debt. Okay. And then, so when we kind of report what our balance sheet accounts receivable is, it's going to be accounts receivable net. It's going to be equal to this minus our new balance. That's how much we were going to report our balance sheet. Okay. Any questions on this? Yeah. This 1,264. This one. It's just what our target balance is minus our existing credit balance. right? Because now, like, let's just get rid of this. Now when I post this, right, this allowance for bad debt credit is going to be credited here. So now our new balance is this plus this. Okay. Now let me do a little trick. Okay. Let's say that instead of 2,800, this was like, I don't know, 4,000. Okay. Let's just change this to 4,000. So we change this to 4,000, change this to 4,000. Okay. So now we have a debit balance here. Okay. And we have a different balance for account receivable. Think about now what the adjustment would be. What is the adjusting entry now? Take a minute, see if you can calculate that. Okay, so it's the same math. It's still 2%. So we do this times 0.02. Okay, so now we know that our allowance for bad debt, it's got to have a credit balance of 1,240. We have an existing debit balance of 1,000. So how do we get from a debit balance of 1,000 to a credit balance of 1,240? What do we need to do? The allowance for bad debt. Yeah, Adam. Exactly. Okay. We need an adjusting entry of 2,240. Okay. So let's just we'll change this to 2,240. Okay. So when you do this, again, if this is our existing balance, we then have this credit 2,240. Our new balance is this minus this, which is what we wanted. Okay. So we had to take a much bigger expense here. This is going to reduce our net income. And the reason why is because we messed up in the previous period. We didn't have enough in our piggy bank. So now we're paying for it in the next period. So this is why even with the allowance method, it's not perfect. You're not going to have an exact matchup between the expenses for bad debt and the revenue, right? Because if you under reserve in previous periods, you're going to pay for it later. Okay, so you're still kind of violating the matching principle, but at least you tried. And again, if you're like an honest and like fair-minded uh, business, you're gonna try to do a good job and not really have this happen regularly, where you under reserve and then you have to take a much bigger expense later. Okay, everyone makes sense? Is this clear? Yeah. Okay. Okay, so let's move on to the last of the three. Okay, so it's very similar to a percentage of receivables, except we're now going to break out the accounts receivable more granularly. Okay, um, so again, it's a modification of the percent of receivables method. Okay, we're using the same concept, but we're now stratifying our accounts receivable because before it's just in one T account as like one balance. Now we're going to have this is the kind of the balance in the T account, this 6,375. But we're now breaking it out between these different, like kind of aging, as it's called, how old the account receivable is. Okay. Um, if it's older, is it more or less likely to be paid if an account receivable is old? Less likely, right? It means the person is just, it's lingering around. Okay. So that means, as you can see here, we're going to apply a higher percentage to this, meaning that we're assuming of this $100 that's in this tier, you can see here, we're assuming that 90% of whatever's in here is going to be uncollectible. Okay, because we're assuming if it's gone this far in age, then it's just uncollectible. Okay, there's only a 10% chance they're actually going to pay us at this point. So you can see here that the weighing is going to be kind of backloaded. As these get older, you're going to have a higher percentage of like uncollectability. Okay, so this is a more accurate way of doing this because you're kind of you're doing a more common sense approach and looking at the details of your account receivable and doing a risk weighting. Okay, the older ones are riskier than the newer ones, and you can see that reflected here. Now, of course, these percentages are at the discretion of the business. They're gonna come up with some way or method of getting to these percentages. Okay, and that's an analysis that some accountant is going to do in the business and look at old records and see how often, if something got to 60 to 90 days, what percentage of them ended up paying. There will be some analysis to get to those percentages, but it's at least going to follow this general trend of riskier as things get older. Okay, so now we apply these percentages to each of these buckets. You can see here. And you can see that most of the accounts receivable are in this newer bucket because, it's probably trade receivables and they're given 30 days to pay. And so most of the accounts receivable are in there. And, most of them pay because you can see how many of them make it to this next bucket. It's a much smaller percentage. And then how many make it to here. Actually, this one, it looks like there's one guy who's kind of lingering here. Okay. Um, but typically you'll see also a decline in the balances as the age goes out. Okay. And then so you apply these percentages and then you get based on these to a target balance. So it's the same thing. Now this is going to be the balance target for allowance for bad debt. And then you just do the same procedure. So the only difference now is that we have this table and the risk stratification. That's the only additional new thing. Once we have this 185, we can then look at our existing unadjusted balance in allowance for bad debt. This is our new target balance, and then we would just calculate the adjusting entry the same way as we just did. Okay? Okay, so let's do a practice problem with this. You're going to be given a table like this, and you'll just have to figure out what this target balance is based on that table. And that's the only new thing. Once you have that target, it's the same thing as we just did in the last problem, because you now have the target for allowance for bad debt. Okay, so it's going to be 8-21. It's just the next tab. You can see here you have a table here with the different risk parameters and the different balances for each class. Okay, so it's you just have to do the math for that, and then figure out what the adjusting entry is. So go ahead and try that on your own. We'll do it together in a second. I really want you all to start trying to practice as much as you can using Excel. Okay. I know it's like you're familiar with the calculator and it's slower in some ways to do it with Excel, but it's the only way you're going to learn it is if you just practice. Okay. So I'll show you why I think it's useful. Okay. So I'm just going to copy the numbers. Okay, and it's make sure you're clear. This is 0.4%, not 4%. Okay, so that's easy mistake to make. Okay, so the formatting is oops. Yeah, it's a little annoying. Okay, so let me just make sure I have all the numbers correct here. Okay, so I have all my balances, the total receivables. I can use this function called sum, equal sign, sum. I would add these up. So my T account, if I had accounts receivable, I'm going to have all the transactions for the month. And then at the end of the period, I'm going to have a debit balance of 210,000. Okay, so what we're doing here is we're taking this T account balance for account receivable and stratifying it. Okay, so the total is going to appear in my accounting system in the account balance, but this level of detail is something we've now added to help our analysis. Okay, so now again, using Excel, like using a calculator, you'd have to do each of these multiplications separately. Okay, but in Excel, what you can do is just equal sign this cell times this cell. I'm using cell references. And then I can do either, I can go onto this, the corner of this cell and just drag it rightwards. Oh man, these all merged. Gosh, hold on. There's like a weird formatting thing here. Let me just fix that. Okay, so now, come on, man. It's because this is merged too. Okay, all right. Third and final try. Let's see. Okay, so this does all the calculations. Now, why is this useful? Not only did it make the calculations fast, let's say I like wanted to change something. I said, no, actually, this is 5%. I could just change one number. It's automatically going to update the calculation. Okay, so Excel is very helpful for not only doing calculations, but again, for making it a dynamic spreadsheet, meaning things that are dependent on other things will get updated automatically when you change one thing. Okay, you don't have to redo everything. As long as you're using the cell referencing, you're using formulas, it becomes dynamic. And if you become someone that works in finance, it's like it's impossibly long, or not impossibly long because they used to do it before spreadsheets, but it's gonna save you a ton of time. Okay, and this is gonna be the way that you would do your work. Okay, so I suggest that you kind of start practicing with it now for the rest of the semester. Okay, so now when we add this up, we have our target balance for allowance for bad debt. So actually, let's just do this. Okay, so again, it told us that we have an existing balance here, and it's telling us it's a debit balance. So this is a key detail. You need to realize whether allowance for bad debt has a credit or debit balance. Okay, in this case, it has a debit balance, which means that did we over or under reserve in the previous periods? Did we were we too aggressive or were we too conservative? Who thinks that we were too aggressive, meaning that we did not reserve enough for losses? Okay, who thinks we were too conservative, meaning we over reserved? No, yes, we were too aggressive. We did not reserve enough. The credit balance that existed for allowance for bad debt was more than offset with losses, right? Because whenever we took a loss, whenever we wrote off an account receivable, we would debit allowance for bad debt. There were more debits than there was credit balance. So that's why we have a debit balance. So now we're going to have to pay for that. We need to have this as our adjusted balance. We're going to have to take some credit here as our adjusting entry. Okay, so how do we do it? We add. We will have to add this target balance plus 1,600. Okay, so we have to take an extra large. Not only do we have to get to 11,920 credit, we have to take an additional 1,600 of expense to make up for the previous period's aggressive reserving, where we did not reserve enough. Okay, so we now have our amount for the adjusting entry. And again, the form of it is bad debt expense. This is going to be a hit to our profitability in this period. We're taking an expense, and we're going to add to our piggy bank, which we call allowance for bad debt. And again, this is going to be at the end of January. This is an adjusting entry. Okay. Now this debit balance is, this allowance for bad debt at some point in the period became wrong, right? As soon as it entered into the debit balance territory, it was wrong. And we're now only at the end of the period correcting it. So yes, that's a problem. Like in the interim period, it was our balance for account receivable would have been incorrect, but we're now fixing it at the end of the period. So, um, it's it existed incorrectly and it's only getting fixed at the end of the month, which is another reason why doing adjusting entries is important, because there could be balances that are incoherent unless you kind of check through, make sure your contra accounts, everything is kind of coherent, especially for these accounts where you're reserving, okay, which are based on estimates, because the estimate is never going to be exactly correct. I mean, it could be, but it's like a very unlikely that you're going to estimate at the beginning of a period exactly how future is going to play out. There's always going to be some true up that has to happen. Okay. Okay. Any questions on this? Everyone good with this idea of uh, bad debt expense? Yeah. Okay. All right. So let's move on. There's another kind of meta topic to cover in this chapter, about notes payable. Okay. So again, notes payable. It's very similar to accounts payable, except a couple things. Number one, there's going to be some formal contract that is going to outline the terms of this agreement between the borrower, the debtor, and the creditor. Okay, so if we are having a note receivable, we are lenders. Okay, we are expecting to receive. We've like lent money, or we've provided services, or we've provided some goods to someone, and we're expecting to receive money later. Okay, so so in the case of notes payable or notes receivable, I guess this should have been receivable. I mean, it's really again, it's symmetrical, right? If there's a notes receivable, there's also going to be a notes payable on the balance sheet of the borrower. Okay, but again, this chapter is about receivables, so we're assuming that we are the lenders. Okay, so some terminology. Principal. This is the amount that is loaned. If it's the if you provided services, it's the value of the services that you've fronted. Okay, but it's going to be the amount that you've kind of lent to the borrower. There's going to be interest. Okay, interest is basically it's like a rent. Okay, whenever you use someone's house and live in it, you're paying them for the kind of the right to kind of use their stuff, right? It's the same thing with using people's money. If you use someone's money to buy a car or buy a house, you're going to pay them for whatever amount of money is still being borrowed, right? And you're going to not only pay them that rent, quote unquote rent, for that amount you borrowed, you're also going to at some point pay them back that money. Okay, so interest and principal are two separate things. The principal, again, is how much you've actually borrowed, and the interest is the rent that you're being charged for the right to kind of have borrowed that whatever you're borrowing. Okay, um, it's usually expressed as a percentage. I think we all have probably seen interest rates being expressed. Um, and it's usually stated per year. So if it's 8% per year, to get a per day interest, we just divide it by 365, and so we can get a per day interest rate. Okay. Um, Maturity date. Okay, this is when the final payment of a loan is due. So a lot of, like, when you borrow a mortgage, like when you buy a house and get a mortgage, the maturity date is actually not that special, because a residential mortgage is set up such that each payment is exactly the same amount every month, and it includes interest plus some amount of principal, so that by the end of the 30 years or 15 years, the principal balance is zero. Okay, so every month you're paying off the interest plus some amount of the balance that you borrowed, and the math is perfect such that on the last payment date, the last payment is just going to bring your principal balance to zero. Okay, and we're going to see that in chapter 12. We'll do like a table, and we'll see how a mortgage uh, amortization table looks, and you'll see that every month your balance on your mortgage goes down, goes down, goes down, goes down, and by the end of the 30 years, it will be exactly zero. Okay, and the payment amount per month is exactly the same. It's not a trivial math problem to figure out how much that payment should be. And there's a function in Excel that does it automatically, but we'll kind of see that in chapter 12. Some loans, you're only going to pay interest and no principal, such that on the maturity date, you have to pay back this big lump sum of whenever you borrowed. Okay, I think we watched the video on General Growth Partners, that real estate company that had those big maturities, and they could not find a new lender to help them pay off those loans that came due, and that was a problem for them. Okay, so most commercial loans have big payments at the end because they don't get, most banks will not lend for like 30 years to a business. Okay, they're usually going to be shorter term, 5 to 10 years, and it's hard to pay off a large principal balance in 5 years. Payment per month is going to be too big. So there's typically going to be a large balloon payment on the maturity date. So in that case, the maturity date is actually really important. Okay, because at that on that last date, you're going to have a really big payment. So maybe you're paying $1,000 a month, but on that maturity date, if it's a commercial loan, it's going to be $1 million, something big. Okay, so you have to come up with that money somehow. Okay, and then there's a payment schedule. So this is like for loans, for bonds, there's a fixed payment schedule. Every month, you can plan out every payment for the entirety of the loan. Okay, if assuming a certain, assuming that it's a fixed rate, fixed interest rate. Some loans have floating interest rates that change over time. But if it's a fixed rate, fixed interest rate loan, you can plot, and the maturity date, how long, what the term of the loan is, as they say. You can have an exact calendar of how much every payment is for the whole life of the loan. Okay, and that calendar and that tabulation is called a payment schedule. Okay, so I think I have some examples. Let's see. Okay, so this is an example of a promissory note. This is actually a loan that I, in my business life, bought at an auction. Okay, the bank wanted to sell this loan, and they put it up for auction. So what they're selling is essentially this contract. This is what I bought. Okay, um, it's a it's a mortgage that's secured to a commercial property in Fremont. Okay, so what does it say? It says the loan date was 2005. Principal balance is 127,000, and it was a 25-year loan because the maturity date is 2030. Okay, and then it's gonna list all the terms. So it has the payment information here, and this is all in legalese. Really, uh, lawyers and for whatever reason they make it just so obscure and like difficult to get the relevant information. But it's basically saying, the interest rate. It was a floating rate loan. So it's saying how is that new interest rate calculated? How often is it calculated? So it's saying, if you read in here, it's using uh, prime plus, let's see, where is the spread? A margin of 1%. And so they're using what is it? The prime rate published in the money rate section of the West Coast edition of the Wall Street Journal. Okay, so when I wanted to recalculate what the new interest rate is, I have to find the West edition of the Wall Street Journal on the date of when the interest rate resets and see what that prime rate is, and then add 1%, and that's the new interest rate. Okay, so all this is specified in this agreement. There's prepayment penalty, meaning if he pays the loan off early, what happens? If he makes a payment late, what happens? So all these different terms are spelled out in this agreement. Okay, this is like kind of what a promissory note looks like. It's also going to say what this loan is secured by. So he basically pledged his property to guarantee the principal of this loan. So if he stopped paying, then uh, whoever, the bank initially, but then they sold the loan to me, I could then foreclose and kind of collect the money through selling his property at an auction. Okay, and he's signed over that right when he took this loan. Okay, so it's all spelled out here. And of course, signs it. This is the most important part, actually. If you didn't sign it, then this contract is not valid. Okay. All right. Any questions on this? This one? I think I had another one. Let's see. What is this? Okay, so I just made, me and Gemini came up with like what were the main terms. So that whatever 5-page legalese document. What are the relevant things, right? I just had ChatGPT read it and summarize. So the borrower, I just kind of changed his name. The lender was Zion's First National Bank. Okay, they're the ones that initially gave him the loan. I bought the loan from Zion. Okay, they for whatever I think he was in default, he had stopped paying, and they just didn't want to deal with it, so they were selling it. Okay, um, I of course did not pay the outstanding balance. I bought it at a discount. Right, that was the incentive for me to kind of take on a loan that's not paying. Okay, so they were willing to part with it and just get the cash. They didn't want to deal with anything else. Okay, so that was my incentive, was to deal with this guy, and actually the guy turned out to actually sell the property and pay off the full amount of the loan. So it was a good deal. Okay, so yeah, so the interest rate is initially this, but it's going to be it's variable. It changes um, quarterly, right? So every 4 times a year, the interest rate is going to vary. It could go up, it could go down. Um, and then there's a payment schedule. So for the first 10 years is one thing, and then the next 10 years or 15 years is something else. And it was fully amortizing because you can see on the last day um, is just going to be some payment. So it was a fully amortizing loan. Okay, so essentially, I just wanted to show you this is like a real world, like this stuff actually gets incorporated into real legal documents for notes payable. Okay, so knowing this terminology is important. Yeah. Yeah. So then I would have had to hire a company that basically is a third party, because I don't own the property. I'm just the lender. But the terms of the loan and the security that he's kind of signed over allows this third party to conduct an auction. Okay. So uh, that third party would do all the filings, kind of public notice to say, hey, this property is going up for auction. The sale would happen. If no one bought it at the auction, I would then own the property, and then I could sell it. Okay, any other questions? This? Okay, yeah. If you end up working in banking, like this would be your life. You're just dealing with these contracts, understanding these terms, negotiating these terms. This is what a bank does, essentially. Yeah. Okay. Why don't we take a couple minutes break and then we'll continue on. All right. I think most people know how to do this, hopefully. Um, but how to compute interest, okay? Uh, some examples. Okay, I guess the formula is you take the principal outstanding times the interest rate times the amount of time. Okay, so this can all, it's really the time is going to be the variable, like the unit is going to vary. Okay, so in this case, we have $1,000 loan. How much is 1 year of interest? 6% interest rate. This is easy. It's this principal times 6% times 1 year, because this is the yearly interest rate, is $60. In this next example, $2,000 loan, 9 months of interest. Months, okay, so this is the key unit is months. 10% again is the annual interest rate. So if you wanted to figure out what the amount of interest is, you have to do some fraction, okay? Hopefully this is not mind-bending mathematics. It shouldn't be. Principal amount times the rate times, and again, this is a yearly rate, so you need to have the fraction of a year. So 9 months over 12 is going to give you 3/4, right? So you're only going to calculate interest for 3/4 of a year, and you get $150. Okay. Now, what about this? This is now the next, this one requires maybe a little bit change in uh, strategy. Okay, so you have a $5,000 loan. Now we're going into days. Okay, 65 days of interest, but the rate is still quoted in years, like a yearly rate. Okay, so one way to do it is to keep your rate as a year and then figure out what fraction of a year 65 days is. You could convert this into a daily rate by doing 0.12 divided by 365, and then this times 65 days. Okay, so it's up to you. But basically what you have to do is make sure that your interest rate and your time period are in the same units. So if this is a yearly interest rate, this time period has to be in years. In this case, it's a fraction of a year. Okay, everyone understand this? This is like hopefully pretty straightforward. Okay. Um, there's an easy way to calculate the number of days between two dates in Excel. All you have to do is subtract them from each other. Okay, so for example, if we had 1/5/2025 and let's say 5/15 to 1999, okay, so two random days, I could just do one minus the other, and it tells me exactly how many days are between those two. Okay, so this will be useful when you're given a payment date for a loan and the origination date, and you're calculating how much interest has accrued. Okay, because you'll just have to subtract two dates from each other. Yeah.
So when you're working with this, the longest terms like 9 months, right?
Right.
And well, like somewhere in the middle when the year ends, if these are not the like in the first year, it's not the full months. It's like some months, some days. So we transfer calculation into days for all of the period until the
Okay, in the real world, you don't use this months thing. Everything is in days. In the real world. In the book, they will make it on, it'll be like whole months,
one
One question was,
that was
yeah, 1 day plus or minus, but you just assume it's the full month.
okay.
Yeah, yeah. But in the real world, it's going to be on a daily basis. Like interest, when you're dealing with hundreds of millions or billions of dollars, each day matters. So it's like really the day counts will be, it'll factor in the day counts. And even the method of how you count a year, there's like different, like there's some day count method that's assumes 360 days in a year, and each month is exactly 30. There's one called actual over 360, which is the actual day count over a 360-year day, and then there's actual over actual. So there's different even ways of how you divide up the months and the days in a year. Okay, so because each day does matter, like that, those little differences will translate to real money when you're dealing with large sums. So in the real world, it's a little more complicated, but we're just keeping it for right now relatively simple. Okay. So yeah, just make sure that you use this Excel trick. I think it's going to make your life a lot easier if you can easily figure out how many days are between two dates. Okay? Okay. So um, I think we've seen some of this already when we were doing chapter 3 with the accrual of interest. But just to review, um, in this situation, we made a loan of $1,000 on this September date, September 30th, so it's the end of the month. It's a 1-year loan. Interest rate is 6%. And at the end of December, at the end of our accounting period, we want to accrue interest, okay, as an adjusting entry. We want to make sure that our 2025 financial statement includes the correct amount of interest revenue, right? Because we're, again, the lender. So just to review the accounting entries, the journal entries, when we originate the loan, we have a note receivable. We're lending cash. To figure out how much interest is from here to here, the calculation is right here, $1,000 times the interest rate, 6%. And we have end of September, so October, November, December, 3 full months of interest, which is where we get this 3 out of 12, 12 months in a year. And so we get $15. That's how we know how much interest to accrue, is by doing this interest calculation. We then do our adjusting entry, right? Interest receivable, because again, the payment is only once in a year. It's going to happen after a year, but we're going to until then have this receivable, and we're going to record this revenue. That's the whole point of the adjusting entry, is to make sure that $15 of this revenue is included in my income statement. Okay, so now when the payment happens, we're going to have the rest of the interest from here, from the end of the year to the payment date, is just the rest of the 9 months of the year. Because remember, 3 of it got included in this last period. 9 months is included in the next year. And then when they pay us, they're going to pay off the principal. They're going to pay off this receivable that we recorded. And we're going to also have this revenue for recorded in this 2026 year. So now in 2026, in the income statement, we're going to have $45 of interest, which is correct, right? In the last year, in 2025, we would have shown the $15, which is also correct. Okay, so again, this should be a review. I think we've already done this. Are there any questions? Anyone forgot something and want to clarify? No? Okay. Okay, good. Um, oops. Okay, so maybe we'll do a practice one. Um, so this is a little, I'm gonna ask you to do, like, now the day count stuff is a little weird, not typical. You have to use Excel for this. So on November 19th, so random day, this company makes a sale and accepts a 60-day note. It's a $5,000 note receivable. Okay. Um, so just do the journal entry. It's okay, so it's a little weird. Okay, what we're doing here is we're converting an account receivable. So this is basically what happened, is that the company, this customer of ours, had an account receivable. They're like, I can't pay you right now. So what we're doing is we're converting that account receivable to a note receivable. Okay, so that's part of this journal entry. And it's now 60 days. Okay, so there will be one that happens. There's one journal entry that happens here where we convert the account receivable to a note receivable. We'll do an adjusting entry based on now this note receivable has a stated interest rate, and there's been some amount of time that's passed from here to here. So you have to do a journal entry here for calculating that interest. And then when you pay it off, there'll be another one here. Okay, so see if you can figure that out. And really, I think the difficulty will be in doing the interest calculation. And maybe this first one, converting an account receivable to a notes receivable. It shouldn't be, because I'm telling you what you have to do in words. But yeah, try to do this on your own. We'll take a couple of minutes and see if you can do that. Okay, so the first one, this first journal entry, we're just going to do, we're getting rid of an account receivable and we're receiving a note receivable. Okay, so it's basically note receivable 5,000 debit, and we're reducing accounts receivable by 5,000. Okay, so now this customer, they no longer, we've just traded the terms basically. Like one is accounts receivable is short term, we're now making it a long term loan. Okay, now how do we calculate the interest from the time that that happens to the end of the year? Well, I can just go here. So I have these two dates. I just subtract one from the other. It's 42 days. Okay. And then it's a 12% interest rate and the principal balance is 5,000. So this is days. Oops. Interest rate. And then principal. Okay. So I have all the parameters that I need. Okay, so if I want to figure out how much interest to accrue, I will just do principal balance times the rate, which is a yearly rate, times the number of days divided by 365. So 42 divided by 365 is the fraction of the year that I'm calculating interest for. So $69.04. Okay, so then I have my journal entry. So I have here, the journal entry will be interest receivable. What was it? $69.04. And we'll have interest revenue credited. Okay? Yeah. Yes. Okay. So then when they pay us off, okay? Um, so we had 42 days here. How many days are going to be in the next year? This is kind of like not drawn to scale because 42 is like the majority of the 60 days. So how many days are here? 18, exactly. Okay. So um, so total interest, I guess the total interest paid is going to be basically principal times this interest rate times 60 divided by 365. Okay, so this is the total interest that they're going to pay plus the principal of 5,000. So we know that it's going to be basically cash. It's going to be $5,098.63. Okay, I would start with that. That's like the most obvious part of it. How much cash they're going to give us total, principal plus total interest of 60 days. That's how much I'm going to debit because that's cash I'm receiving. Now, what goes away? The obvious part is notes payable, or sorry, notes receivable. That's going to be 5,000 credit. They're paying us off. We had that as an asset. Now they're going to kind of pay that balance off and we no longer have that asset. And now it's like the little tricky thing because we have that interest receivable from the adjusting entry. So we see that this interest receivable was $69.04. And then the interest revenue for those 18 days, right, of the next year, some of the interest, some of this $98 is of course revenue for the next year. So you could just either, we could go back to this Excel sheet and just do a calculation like this: 5,000 plus 12 times 18 divided by 365. But really, it should also be this plus this should be $98.63. So it is. Okay, so we could have also just done it a different way by taking the total minus what we accrued. It will give us the same result. Okay, so $29.59. $29.59. Okay, so this would be our journal entry for this payment. Yeah.
So there's a tiny difference between subtracting what we totally have to receive minus um, accrued
Okay.
and compare it to if you count 42 days, 18 days. And as you said, like
It's some rounding difference. Yeah.
what is the method that usually is done for banks? Like are they at the final or they go in the like
They'll just go down to the cent, like even if it's $1 billion, they'll just go around to the nearest cent.
day by day, or they're looking at the total?
Well, I mean, they'll use the most, like they'll get like everything will have some long decimal points at the end, right? So they will just round everything to the cents by the end of it. Like that's like they will round everything to the nearest cent.
Yeah, I understand that they're gonna round, but are they aiming for the final 60 days total?
Yeah, I mean that's the payment, the actual cash transaction is going to be the one that is the most important. Yeah. Yeah, because that's when cash is actually transacted. So whoever's paying the cash is not going to care about your internal record, like accrual recording. Yeah, they're just going to care about how much cash they're going to pay. Okay. Any other questions? No. Okay. All right. So hopefully that was kind of review. I think we've seen this. Okay. So this is kind of like an odd little topic in this chapter where uh, it's not a account receivable that's unpaid. It's a dishonored note. Okay, so this is kind of the equivalent of when someone doesn't pay a note payable. Okay, so what happens there? So again, dishonored note is that a note that the borrower defaults on. Okay, so something weird is going to happen in that we're going to actually, since we have this piggy bank already set up for accounts receivable, we're going to move the note receivable into accounts receivable and then write it off. Okay, because we don't want to, whatever. There's probably different ways to do this. Okay, if you're the accountant for a company, this is not like some kind of rule from God that says you have to do it like this. This is just how we're learning it in the book. But there's different ways that you could theoretically set this up, but we're just going to follow this like a little formula for now because it's good practice. You can kind of see again how the system of debits and credits is quite flexible. But don't think that this is like the only way, that this is like some ordained way of dealing with dishonored notes. Okay, so with that in mind, how they want you to do it in the book in your homework is you're first gonna transfer the dishonored note receivable, and this is the weird thing, plus all the unpaid interest. Okay, so you're gonna almost assume that the person paid you, and you're gonna record a revenue. This is again really weird. Okay, you can see here that this interest revenue of $60 you're gonna record, even though this person's not paying you. Okay, this person has said, "I'm not gonna pay you," yet you're still gonna record this revenue. Okay, so you're going to record the amount of the note receivable plus the unpaid balance, and you're going to put everything into account receivable. Okay, Now the second step is that you're going to write it off. Okay. Now you use, just like we did with accounts receivable, you're going to use your piggy bank for allowance for bad debt to write off the entire amount. Okay. Now, why does this work? Well, this interest revenue is going to be offset theoretically by some bad debt expense. Because remember, this allowance for bad debt, it's created through taking an expense. Okay. So yes, it's weird, but it eventually should theoretically get netted out by bad debt expense. Okay. So, but yeah, it's strange. I think it is quite a kind of a circuitous way of dealing with this. But again, it does work out. And I think it's good for you to think about how, though you're going to show this interest revenue, it's going to get offset at a different kind of adjusting entry for this bad debt expense. It does net it out. Okay. You will correctly take the expense for like this will get netted. Okay. It's not gonna actually increase your net income. Okay. Does everyone understand? Any questions? Any confusions on this? It is confusing, I'll admit. It's like, again, not very straightforward. Okay. Um, okay, I'm gonna do the last ratio thing, and then we're just gonna work till the end of the class on our practice problem. Okay, and I don't know if we'll finish it, but we'll at least try to do some of it. Okay, so look, there's a set of ratios we've already talked about that have to do with meeting your current liabilities. How much coverage do you have to pay your current liabilities? We have the least stringent that we already saw was the current ratio, which takes all your current assets and it divides it by the current liabilities. Okay. So that's the most permissive because you're not differentiating within your current assets, which ones are liquid, which ones are less liquid. You're just taking all your current assets. Okay. Now, the most stringent, meaning the most strict, is the cash ratio, where you just, of your current assets, you just look at cash. How much cash do you have to cover your current, sorry, this should be current liabilities. Fix that. Okay. This is the most stringent because you have all these different current assets, but you're just looking at the most liquid. Now, a middle ground is the quick ratio, which is what is covered in this chapter, where you take your cash equivalents, short-term investments, and AR. The big one that's not included in here is inventory. Okay, because as we saw, like with restoration hardware, some businesses, it takes them a while to sell their inventory. It's not as liquid. Okay, so this middle ground strategy is using the more liquid parts of your current assets to see how much coverage of your current liabilities you have. So it's like kind of a middle ground. Yeah, Chris.
When doing the quick ratio, some businesses wouldn't advertise their inventory into short-term model.
Well, inventory is going to be current. I mean, for the most part, I don't think really many businesses have long-term inventory. So inventory will almost always be part of current assets. It's just in the quick ratio, you're not going to include it in this ratio because you're like, it may take a long time to sell the inventory. So it's not going to be quick enough to pay your current liabilities. Okay. Okay. And then finally, the asset turnover ratio. Um, we talked about the banana uh, in chapter 5, I think, where we had the gross margin. So if we had a banana that cost us $1, there's two levers we can pull. If we can sell it for 5, that's a high gross margin, right? We're selling it for 5 times what we bought it. But maybe we're not going to be able to sell as many. We're not going to turn over as many. If we reduce our gross margin, maybe we sell it for $1.50. The gross margin is less, but we're turning it over way more times. Okay. Sorry, I'm totally. We already covered this. Okay. Sorry. This is the accounts receivable turnover ratio. So this is a different thing. Sorry. Let's redo this. Okay, so this is really measuring how quickly you're collecting your account receivable. Okay, so uh, you want to see basically how many times that this cycle of extending credit and collecting the cash can happen in a period. And so you're looking at the amount of credit sales that you make in the period as a function of how much accounts receivable balance you have. So it's another one of these turnover ratios. It's a similar thing where you see what the total kind of volume is compared to the balances at the beginning and the end of the year. Okay, so this average net accounts receivable, you take your beginning account receivable balance and your end account receivable balance, find the average, and you compare that to your total credit sales. So let's say you had $100 million in credit sales and you have whatever, $1 million in average account receivable. That means you're collecting the cash very fast because look how low your account receivable balance is compared to the total credit sales. It means that you're generating a ton of sales and the cash cycle is really short, right? You make $1 million of sales, you collect the cash, you make $1 million of sales, and by the end of the year, or the average, you only had $1 million of receivables. Okay, so this is a very fast cash cycle. Okay, and then the opposite is, let's say you had $80 million in account receivable. That means that you're like still lingering, right? You made a bunch of credit sales, but a lot of that is still sticking around in accounts receivable. Okay, so your cash cycle is very long. Okay, so um, another way to kind of visualize or like understand this is you do this turnover ratio, and if you divide 365 by that ratio, you get the average number of days it takes to collect the cash. Okay, so this is maybe a more intuitive way to understand this ratio. It's like how many days does it take from the time you extended the credit to the time you get the cash on average? And so days sales and receivables will kind of tell you that. Okay. All right. So I think it's better now we kind of look at the practice problem, unless there's any questions on this. No? Okay. So let's just spend the rest of the class working on this last one, 8-34, where we just have a bunch of uh, transactions related to notes. Okay, so maybe I'll give you like a couple minutes to work on it, and I'll do it, and we'll just alternate instead of just giving you a big block of time, just so we can try to get through some of it. Okay, so start this. Try to do the first two, and then I'll do them, and then we'll just keep doing that till the end of class. Okay, so let's just do this first one, and again, this should be review because we kind of just did a very similar one. So we're receiving a note in settlement for an overdue account receivable. Okay, so it's going to be $7,000, and we're basically removing an account receivable and replacing it with the note receivable. Okay, okay, everyone good with that? Okay, so now it's asking us to accrue the interest. Okay, so I have the dates here. Again, I will use my Excel to just figure out how many days have elapsed, 25 days. And I can just basically do 7,000, which is the principal, times the interest rate, which is 12%, times the days divided by 365 to get $57.53. So 57.53 is the amount. Okay, and again, I'm going to have interest receivable and interest revenue. This is an adjusting entry, so it's going to be dated at the end of the year. Oops. Okay, and then collecting the maturity value. Okay, So this is again going to be on March 6th. Is that exactly 90 days? Let's see. You can also add numbers. Okay, so if you do the starting date plus 90, we can see, yes, on the 90th day, 3/6. That's correct. So it's 90 days later. So 3/6/2026. So we're into the next year. So again, I would start with the cash that we're collecting. So we're going to collect $7,000 of principal plus 7,000 times 0.12 times 90 divided by 365. So in one calculation, I'm adding principal plus interest. Is everyone good with this? Everyone see what I'm doing here? Yes? Okay, so this is the total amount of cash that I'm going to collect. Notes receivable is going to get reduced by 7,000. This note receivable is now going away. So this and this are offset. This interest receivable is also going away. Okay, and then, the easiest way is just to say this minus this minus this. Okay, this is our interest revenue for 2026. Okay, and just to make sure, if I did, so it's 25 days. If I do 90 minus 25, that's the number of days in 2026 times 0.12 times 7,000. I should get the same number. Oops. Divided by 365. So yeah, it's rounded. Okay. Okay. So everyone should be good with that. So take a couple of minutes, try to figure out these uh, last couple journal entries, and maybe I can do them in the last minute of class. A little bit here. Okay. So on October 2nd, you're going to record this. You're very hopeful this person's going to pay you $2,400. So you have a note receivable, and it was for some sale that you made, right? For a note, yeah. So you're making a sale, and it's like a car loan, right? When you buy a car, it's not an account receivable; it's a note receivable because the car loan is like 5 years long or whatever, right? So this is a similar thing. So you have your revenue of 2,400 in this note receivable, but a couple months later, things go bad. Okay, this person's not going to pay you. So October, so let's see, 10/2/2026, and then we're writing it off on 12/1/2026. That's 60 days. Okay, it was a 60-day note. So the amount of interest that would have been paid that's going unpaid is 2,400 times 11% times 60 divided by 365. So $43.40. So we're going to have on December 1st, we're going to be, remember, putting this into accounts receivable for this person, Basque. And we're going to be getting rid of the note receivable. And we're going to be recording this interest revenue. Okay, so we just calculated the interest revenue, which was this $43.40. The note receivable is 2,400. And this account receivable we now have is the sum of the two. Okay, so that's just the first step. Now we're going to write this account receivable off. Okay, because it's uncollectible. So we're going to use allowance for bad debt, and we're going to write off this entire amount. That's it. Okay, so now we've kind of removed it from accounts receivable. We've also removed it from, sorry, we removed it from notes receivable, and we removed it from accounts receivable. It's like uncollectible, and we've, indirectly through this allowance for bad debt taken an expense for it. Okay. Any questions? Any last questions on the midterm?